Hello, everyone. In this, we are going to continue our discussion of the cost of capital. This time, we are going to discuss the cost of debt. Of course, as we know, the debt has a smaller risk than the equity. In this case, the cost of debt would be smaller than the cost of equity. What is the cost of debt? The cost of debt is the required return on a company's debt, or is the minimum cost that the company has to pay in exchange for using a debt. We can estimate the cost of debt with two methodologies. One is campaign. Because debt is an asset, right? Is an asset. So this also debt is a risky asset. So this asset has its own beta or has its own systematic risk. If it has its own systematic risk, then we can use campaign to estimate its expected return. We can use this estimated expected return as the cost of this debt. Okay, because we have just learned how to use campaign to estimate the cost of equity. So we're not going to discuss how to use campaign to estimate the cost of debt in details. I believe the procedure is the same. The other method we use to estimate the cost of debt is to observe interest rate in the financial market. The required return is best estimated by computing the yield to maturity on the existing debt. That means on the current data market, what is the required rate of return for a specific debt with a specific level of risk? Okay, and then this observed interest rate is the estimated cost of debt with this level of risk. I think this is a common method that we use to estimate the cost of debt. Also we can estimate the current rate based on the bond rating we expect when we issue a new bonds. Okay, now we know the bonds on the market is rated. We have the AAA bonds, we have ABB bonds. Okay, we have different rating agencies, and these rating agencies rate these bonds based on their risk. So when we issue a new bonds, when we can then we can determine based on the company's financial position. We can determine, okay, this bonds is approximately the AAA bonds or ABB bonds, and then we can use the current the interest rate of AAA bonds or ABB bonds as the cost of debt for issued bonds. Okay. uh, here, yeah. Before we move on, yeah, I like to point out that the cost of debt is not the coupon rate. Okay, coupon rate is defined as the coupon payment, yeah, the annual coupon payment divided by the face value of the bond. Yeah, for a bond over its life or throughout its life, this number is fixed. However, the interest rate that you can earn on a bond varies on the market as time goes by. Okay, because the market always because the interest rate always fluctuates. Okay, so in this case, it is the current market interest rate that is estimated as the cost of the debt. When we estimate the cost of debt, we usually focus on the cost of long-term debt or the bonds, because compared with long-term debt or bonds, the short-term debt or bonds has a relatively stable current market interest rate. Okay, because for this kind of bonds, they are because their maturity is short, usually less than 1 year, and then the risk is relatively stable, and the cost of debt is relatively stable. So we focus on the cost of long-term debt or bonds. Now let's look at the example. Anyway, we're going to use we're going to estimate the required return. Okay, we're going to estimate the required recurrent market required return as the cost of the debt. Now let's look at the example. Suppose we have a bond issue currently outstanding that has 25 years. That has 25 years left to maturity. The coupon rate is 9%, and the coupons are paid semi-annually. Okay, just as we know, most bonds on the market are semi-annual coupon payment bonds. The bond is currently selling for $908.72 $908.72 for 100 bond. Here, 100 is face value, right? $908.72 is the current market price. Then, what is the cost of this debt? Before we move on, we know, this bond is a discount bond, because the market price is smaller than the face value. Is smaller than the face value. Now, we're going to aggregate this information. We can find out the embedded interest rate or interest rate embedded in this bond. Okay. So we know the price of this bond should be equal to is nothing but the present value of all cash flows that the bond will produce throughout its life, right? So we're going to discount all future cash flows, that is the coupon payments, as well as the final lump sum payment into the present value. Okay. Then we have this formula, right? The price of the bond equals the present value of all coupon payments. This term is the present value of all coupon payments, right? Yeah, because all coupon payments is an annuity. Okay, this is the formula to calculate the present value of an annuity. And then plus the present value of the face value, the final lump sum payment, that is $100. Okay. Of course, yeah, if we want to find out, if we want to find out the the R, okay, here, yeah, because this is a semi-annual coupon payment. Okay. If we then first of all, we want to find out the semi-annual interest rate or interest rate per half a year, right? Of course, yeah, we can use a financial calculator to get this number. If we use financial calculator, if we use the time value function, then what is N? What is N? Okay, N is 25 times 2, right? Times 2. Now, what is I over Y? I over Y is what we are looking for. What is present value? Present value is this one, right? $908.72. Okay, and then payment. Now we know coupon rate is 9%. Face value is $1,000. So annual coupon payment is $90. Then semi-annual coupon payment would be $45. Okay, and be careful. We have to differentiate the direction of cash flows. If you define present value as positive, then the future value should be negative. Should be negative. Okay, and then future value at the end of 25 years, you receive $1,000. A lump sum money, of course, this should be negative. Okay, yeah, I think I can differentiate the direction of cash flow in terms of cash inflow and cash outflow. Okay, currently, if you buy these bonds, you pay out $908.72. So I define this as a negative. Then in the future, at the end of every 6 months, you receive $55. Then that is cash inflow. I define this as positive. Okay, and at the end of 25 years, you receive $1,000. Of course, this is cash inflow. Yeah, positive. Okay, and then you can click compute, and then click I over Y. I believe I over Y is 5%. Okay, I over Y is interest rate per half a year. So YMT, yield to maturity, is 10%. Is 10%. Okay, so then that is the cost of this bond. Yeah, current cost of this bond. That means for this bond, you have to pay a minimum interest rate 10% to the bondholders. Okay, and currently on the market, when this bond is sold out at the price $908.72, that means the investors would receive 10%, yeah, YMT 10% if they hold the bonds until throughout its maturity. Of course, throughout the maturity, yeah, the firm issuing these bonds, yeah, will pay the interest rate 10%. So this is the understanding of this required of return from the perspective of cost of debt. Okay. So that is the cost of the debt. The cost of the debt. Now let's look at the other example. You are planning to issue new bonds that will have a rating of AAA. Currently, there is a AAA bond on the market with the following information. 15 years to maturity, coupon rate 12%. Coupons paid semi-annually. Current bond price is $1,253.72. Okay, now we can see that is a premier bond. That is a premier bond. If you will price your bond at the par value, what is the coupon rate you will have to pay to the investors? Okay. This question is a little bit tricky. Okay. The basic idea is now you want to issue a new bonds. You want to issue the new bonds, and you want to determine, yeah, when you want when you now you want to issue a new bonds, and you will price your bond at its par value. Okay, that means you want to sell your bond at the price of $100, right? $1,000. $1,000. Okay. And then, of course, when you sell your bond, yeah, you have to set up the coupon payment. The coupon payment. Or you want to set up the coupon rate. The coupon rate. Okay. Now we know. When the face value is equal to its market price. Yeah, its market price. Now, yeah, you want to set the market price, yeah, at the face value, right? Then in this case, yeah, we know the coupon rate should be equal to the market interest rate. Should be equal to the market rate, right? So the question boils down to how to find out the market interest rate of your bond. Now you know. Currently on the market, there is a same AAA bond. Okay, same AAA bond. And because your bond is a AAA bond, and currently on the market, there is another bond that is also the AAA bond. So in this case, we would conclude, your bond has the similar market has a similar risk as market AAA bond, right? Then in this case, the cost of debt or the cost of your bond should be similar to the cost of currently market AAA bonds. So if we find out current market, current AAA bonds on the market, yeah, if we find out the cost of current market AAA bond, then its cost should be the cost of your bond. So that is the basic idea, right? So now, yeah, we're going to find out this bond currently existed on the market. Yeah, we're going to find out the cost of this bond currently existed on the market. Once we find out it, yeah, because your bond has the same ranking, so your bond, yeah, will have the same cost of debt. Okay. So now, yeah, let's look at this AAA bond currently existing on the market. We know the information about this bond, 15 years to maturity. 15 years to maturity. Okay, coupon rate is 12%. Coupon payment semi-annually. Current bond price $1,253.72. Okay, then what is the embedded market interest rate that we can calculate? Right, we can calculate. In this calculation, yeah, of course, yeah, we're going to use the time value function or financial function to do this calculation. Okay, because it is a semi-annual. That how many half years over 15 years maturity course, N is 15 times 2, right? I over Y is what we're looking for, okay? And then the PV is this number, right? Yeah, that is current market price. So that is 1,253.72. Okay, then payment coupon rate is 12%. Then annual payment would be $120. Semi-annual payment would be 120 divided by 2, right? Okay, and then FV is 1,000. Okay, and before we operate our calculator, we have to define the cash flow directions. As usual, we define present value as negative. Then payment and the PV, FV should be positive, right? Should be positive. Okay, and after you operating this calculation, this operation, then you can get the I over Y. Okay, I want to point out when you get the I over Y on the screen, this is annual semi-annual interest rate. Okay, and then yeah, usually yeah, we have to convert the semi-annual interest rate into a YTM, into YTM. How can we get YTM times I over Y by 2, right? Okay, so I believe you can get the right answer. That is how to estimate. So now, yeah, until now, yeah, you know, right? We just use what we have learned to estimate the required rate of return. We just look at the required rate of return from a different perspective or from the viewpoint of the firm. Yeah, from the viewpoint of the firm. Yeah, these things that we have calculated are the cost that the firm has to pay in order to use the capital, right? Okay, of course, in chapter also we have learned that there is an other kind of equity. It is called the preferred stock. Okay. Compared with the equity, preferred stock has a smaller risk. However, compared with the debt, the preferred stock has a higher debt. So preferred stock has its own cost of capital. Now let's look at how can we estimate the cost of preferred stock. When we look at the cost of preferred stock, we have to we should understand, or we should keep in mind preferred stock generally pays a constant dividend every period. So that is an important characteristic of preferred stock. Okay, the holders of preferred stock expect to receive a constant dividend every period. In the United States, the dividend is issued on semi-annual basis. The second point is dividends are expected to be paid every period forever, because we assume, right, the firm will be running forever unless the shareholders have decided to liquidate the firm. Okay, so the important assumption is the firm will be running forever. That means the preferred stock will be paid forever, or the holders of preferred stock will expect to receive the dividends forever. Okay, so preferred stock, because of this, preferred stock is a perpetuity. So we can use the present value formula for perpetuity to estimate the cost of preferred stock. What is the formula to calculate the present value of a perpetuity? If you remember, I believe, that is, if you remember, I believe, okay, I use P0 to represent the value or the current market price of a preferred stock. That should be dividend. The preferred stockholders expect to receive, okay, for period, then divided by RP. RP is the required rate of return on the preferred stock, okay, or the cost of this preferred stock. Now, in this time, we can observe P0. We can observe the dividend paid, right? Then, we can solve this equation for RP. Then RP equals dividend over P0. So that is the cost of a preferred stock. If you want to sell your preferred stock to the investors, you have to pay this rate of return. Then that is the cost of the preferred stock, right? That is the cost of the capital. Now let's look at an example. Your company has preferred stock that has an annual dividend of $3. If the current price is $25, what is the cost of the preferred stock? Okay, when you look at this question, you have to be careful. In the real world, the preferred stock, the dividends of preferred stock would be issued on semi-annual basis. Okay, however, in this question, it says the annual dividend is $3. So that means, yeah, in this question, yeah, we assume the dividend of preferred stock is issued on annual basis. Okay, on annual basis, and then the required rate of return that we are going to get is also on annual basis. Okay, now, yeah, I believe until now it is easy, right? If we use the formula, okay, what is the cost of a preferred stock? That should be $3 over price. Over price. Okay. Then that is 12%, right? That is 12%. All right. Now let's look at a firm. A firm use different kind of capitals. Just now we know the firm use the use equity, and also they use the bonds, and also they use the preferred stock. Okay, and now let's look at the capital structure. Okay, what is the capital structure? Capital structure, yeah, is a concept that measures the percent of debt of equity used to fund the firm's asset. That, yes, simply speaking, yeah, out of all capitals that a firm is using, how many percent of the funds is raised as debt? How many percent of the funds are raised as equity, or how many dollars is used as equity? How many of dollars is used as debt? Okay, and then this is the capital structure. Capital structure. And also, yeah, we have discussed capital structure is also called the leverage. Is also called the leverage. That leverage means the use of debt in capital structure. Yeah, specifically, leverage refers to the use of debt in the capital structure. That means specifically, leverage refers to the percent of debt. Yeah, the percent of all funds that are used as debt. Okay, because, yeah, if we determine the percent of funds used as debt, we can determine the percent of funds used as equity. Okay, so in this sense, the leverage sometimes is interchangeable to the capital structure. Yeah, obvious, right? If leverage is determined, the capital structure is determined. If capital structure is determined, leverage is determined. Okay, so in finance, we also use the leverage to refer to the capital structure. Okay, and also, yeah, we know, right? Also, we know leverage. Yeah, why do we call the capital structure, or why do we call the percent of debt as the leverage? Because the debt can work as a leverage to amplify the firm's profitability, right? Yeah, we have discussed this in the financial state, in financial statement analysis. Okay, the capital structure. In the real world, yeah, we also use the capital restructure. That refers to the change the amount of leverage without changing the firm's assets. Okay, the firm's assets, the total assets do not change. we just change, we just change the percent of debt or the percent of equity. Then we call this the capital restructure. Of course, if we increase the leverage by issuing debt and repurchasing outstanding shares, then we decrease the percentage of equity, right? If we decrease the leverage by issuing new shares and retiring outstanding debt, then we increase the percentage of equity. Okay. So a firm can change its leverage, when its assets, of course, a firm can change its leverage when its total assets increases or decreases. Okay, so that is the capital structure. Of course, just now we know the capital structure. Capital structure, refers to the percent of debt or equity used to fund a firm's assets. Then, we can use the weight to describe the capital structure. Now, let's see. Now let's see the capital structure weight. Okay. How can we use the weight to describe the capital structure? The weight are determined by how much of each type of financing is used. Okay. For example, the notation E is the market value of equity. That is the number of outstanding shares times the price per share. That is the market value of equity. And then we can use D to represent the market value of debt. That is the number of outstanding bonds times the bond price. We assume there is no other debt. There is no borrowing from the banks or from other. There is no borrowing from the other creditors. The firm only borrow through the banks. Okay, and then of course in this case V is the market value of the firm. Then that should be D plus E. D plus E. Okay. And now we can calculate the weights. Then what is we use WE to represent the percent of financed with equity. Of course, that is the market value of equity divided by the market value of the firm. Okay, or the total assets. Then we can calculate the weight of debt. That is the market value of debt divided by the market value of the firm. Okay, so that is then that is capital structure expressed as the weight of debt or equity in the total assets. Okay, before we move on, also I like to point out we can measure the value of equity debt as well as the total assets with the book value, right? With the book value. However, in the finance, when we look at the capital structure, we usually look at the capital structure from the market value because market value changes. Right? Market value reflects the current value of the total assets. So in this case, we use the market value to estimate the capital structure. Okay. Now let's look at the example. Okay. Until now, in this slide, we assume there is no preferred stock. If we have the preferred stock, then of course Yeah, we have to calculate the weight of preferred stock in the capital structure. Yeah, in the example, we include the preferred stock. Okay, we have those information. Well, common stock. The price of common stock is $50 per share, and we have 3 million shares common stock. The preferred stock, now we know, yeah, on the market, yeah, the price of preferred stock per share is $5. We have 5 million shares preferred stock. Now we have 75 million dead. Okay, million dead. Now we and because then yeah, we assume this the market value of the debt is 75 million dollars. Okay, then yeah, we can compute the market value. Okay, the market value of equity, that should be $50, the price per share times the shares outstanding. Now we have $150 million market, the market value of equity. In terms of preferred stock, $5 price per share of preferred stock times the shares of outstanding 5 million, then we have $25 million of preferred, $25 million of market value of preferred stocks. Now the market value of debt is $75 million. Okay, after we get this number, now we know the total market value of the firm, or the total the value of total assets of this firm is the sum of these three numbers. Then that is $255 million. Now we can, after we get this, we can get the weight, right? What is the weight of equity? 150 divided by 250. Okay, 150 divided by 250. Then we know the weight of equity is 60%. Then what is the weight of preferred stock? That is 25 million divided by 250 million, right? 25 million divided by 250 million. Then that is 0.1, 10%. Now what is the debt of what is the weight of debt? That is 75 divided by 250. Then that is 30%. Okay, that is the weight of equity, preferred stock, and debt in the capital structure. With this number in mind, then we have a basic idea about the capital structure, right? Or we can say the leverage is 30%. That means that out of total assets, 30% of total assets is financed by borrowing or by issuing bonds. Okay, then the remaining assets are financed by equity, by common equity or preferred equity. That is $70. That is 70%. Okay, 70%. So that is how can we describe the capital structure? Then now let's look at the effects of financial leverage, or let's look at the effects of capital structure. Okay. Now, until now, we know financial leverage means the use of the debt or the percentage of the total assets that are financed by debt. Now, what happens to its EPS and ROE when a firm increases its financial leverage? We wouldn't know, right? Leverage amplifies the variation in both EPS and ROE. Yeah, we have learned this. Yeah, what happens to its tax liability when a firm increases its financial leverage? What happens to its agency cost when a firm increases its financial leverage? What happens to its risk when a firm decreases its financial leverage? So this, yeah, the answer to these questions shows the importance of financial leverage, or shows the importance of the capital structure. Yeah, we're going to answer these questions in detail later on. Okay, that is the second section of chapter 12.